Thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is IMI, who released their full results on the 6th of March. We're delighted to have with us today Edward Hann, Head of Investor Relations, and I'm now going to hand over to Edward to start today's presentation.
Thanks very much, Alex, and hopefully everyone can see and hear me now. So thank you all for joining this webinar hosted by Yellowstone Advisory. And as Alex said, I'm going to talk you through our full year results today, and we'll then give you some time to ask some questions. I should say before we begin that I will be referring to information that's already in the market from our 6th of March results, and any forward-looking comments are subject to the usual risks and uncertainties. So the execution of our growth strategy is creating significant value for shareholders, and we're pleased to deliver another strong performance in 2025. We've now delivered 5 consecutive years of mid-single-digit organic revenue growth, and supported by the delivery of our financial framework, which you can see at the bottom of this slide, we are compounding earnings growth. We delivered 5% organic sales growth and 8% organic adjusted operating profit growth in 2025, and we achieved a 20% operating margin for the first time. It was another year of strong cash generation, and we're committed to deploying this capital for growth and to enhance shareholder returns. Organic investment is at record levels, and we have announced a £500 million share buyback alongside a proposed 10% increase to the final dividend. We expect to deliver our 6th consecutive year of mid-single-digit organic revenue growth in 2026, and we are guiding to adjusted basic EPS between 136 pence and 142 pence. So IMI has been fundamentally transformed since our growth strategy was launched in 2019. We have world-class engineering expertise and have a continued focus on commercial excellence, so we are well placed to address our customers' needs for bespoke, high-value add, fluid and motion control solutions. Supported by 3 long-term megatrends: energy, automation and healthcare, and our focus on the attractive aftermarket, we have now compounded EPS growth at a 10% CAGR since 2019. And as mentioned, 2025 was another strong year. Revenue increased by 5% organically, adjusted profit was at 8% organically, and our adjusted operating margin increased by 30 basis points to 20%. And adjusted basic EPS was 8% higher year on year. Now on this slide, you can see some more detail about our revenue and profit growth. It was our 5th consecutive year of mid-single-digit organic revenue growth, and organic revenue was at 5%, partly offset by the impact of foreign exchange and recent disposals. And adjusted operating profit increased to £460 million, with organic operating profit at 8% year on year, again partly offset by FX and recent disposals. So we've made significant progress delivering sustainable improvements in our margins since launching the strategy in 2019. Our margins are now at 20%, which is 580 basis points higher than 2019, alongside the record investments we are making in our business. Now, reaching 20% margins is an important milestone, but we do expect to deliver further progress over the coming years, driven by growth in our attractive end markets, our strong pricing power, and continued progress in the high margin aftermarket. Now, we have previously flagged that we will be making cybersecurity investments in 2026 to further enhance the resilience of our business, but our strong operating leverage means that over the medium term, we still expect to deliver incremental operating profits of around 30%. So turning to the detail of the income statement, as mentioned, we saw strong organic revenue and profit growth in the year. The net interest charge was £17.7 million, and the tax rate increased to 25.4%, in line with our guidance. Now, as some of you may be aware, IMI's multi-year restructuring program completed in 2024. This program transformed the business, streamlined our global footprint, and laid the foundations for future growth. Our focus is now on continuous improvement, and while we are continuing to look for efficiency opportunities, the costs associated with our current business are being taken into our underlying results rather than as an adjusting item. And as mentioned, adjusted basic EPS increased by 8% to 132.3 pence in the year. Now turning to look at the performance of the platforms and the sectors. Our automation platform delivered strong growth with revenue at 8% organically. Process automation had an excellent year, delivering strong order intake, as shown at the bottom of the slide. And adjusting for the planned disposal of Truflo Marine, orders were up 5% organically, with particular strength in conventional power and nuclear. We made further progress in the high margin aftermarkets, where after a very, very strong fourth quarter, full year orders were 11% higher than 2024 and 9% higher after adjusting for Truflo Marine. Organic revenue was 12% higher than the prior year, and the order book was up another 2%. Industrial automation delivered a resilient performance despite some uncertain markets. Organic revenue was 1% lower year on year. Now turning to the life technology platform, where organic revenue was 1% higher than 2024. Climate control delivered another good performance, with revenue at 5% on an organic basis. We saw continued demand for our products that reduce energy consumption in buildings and benefited from our growing portfolio of smart connected products, including those supporting advanced cooling technologies in data centers. The life science and fluid control sector was flat organically in 2025 as the global life science device market began to stabilize. And the transport organic revenue was 6% lower than 2024, in line with the global heavy-duty truck markets. So IMI is a highly cash-generative business with a clear and disciplined approach to capital allocation, prioritizing investments in our people, processes, and operations that accelerate organic growth. We are committed to a progressive dividend, and as mentioned earlier, are very, very pleased to be recommending a 10% increase to the final dividend. We will also pursue bolt-on acquisitions that enhance our positions in attractive long-term growth markets and have deployed over £400 million in bolt-on acquisitions since 2019, while increasing our fully burdened return on invested capital by 260 basis points to 14%. TWTG, a leading sensor solutions provider acquired for €25 million in October 2024, is now integrated into IMI. TWTG's differentiated product portfolio has greatly expanded our asset monitoring offering, providing us with the opportunity to accelerate aftermarket growth even further. And looking forwards, our M&A pipeline remains strong, and we will continue to seek attractive bolt-on acquisitions that accelerate our organic growth and expand our capabilities while delivering returns in line with our strict financial criteria. And finally, we will look to return surplus capital to shareholders should net debt to adjusted EBITDA fall sustainably below our 1 to 2 times target range. Net debt to EBITDA was 1 times at the year end at the bottom end of this range. And we completed a £200 million share buyback in July and are pleased to have been announced a further £500 million share buyback alongside our full year results, which is now underway. Now, by deploying our growing free cash flow into organic growth opportunities, attractive acquisitions, and value-enhancing share buybacks, we are confident that we can continue our track record of compounding EPS growth. Now, turning to the outlook, we are very excited about the opportunities for growth at IMI and expect to deliver our 6th consecutive year of mid-single-digit organic revenue growth in 2026. We issued guidance on the 6th of March and expect EPS to be between 136 pence and 142 pence in 2026. This guidance assumes that process automation will grow mid to high single digits, supported by the record order book. Industrial automation is expected to deliver another resilient year with organic revenue flat to modestly higher. And we see continued good demand in climate control and stability within life science and fluid control. Transport is expected to be broadly flat in line with the global heavy-duty truck market. Now, we do expect the adjusted operating margin to be flat to slightly up in 2026, with the strong operating leverage offsetting the previously communicated cybersecurity investments. Our guidance also assumes that the disposal of Truflo Marine will complete in mid-2026. We are assuming a net interest charge of £20 million, that our tax rate will increase to 26.3% in 2026, and we are assuming a weighted average number of shares of 238 million following the £500 million share buyback. Our guidance also assumes that exchange rates do not have a material impact on sales or profits. So to talk you through the strategy update. Now, as many of you will be aware, over the last 6 years, we have focused on aligning our business to 3 long-term growth trends: energy, automation, and healthcare. These structural drivers provide us with significant opportunities to create long-term value and will underpin the delivery of profitable growth in the years to come. So IMI is a global leader in fluid and motion control with a compelling value proposition. Our solutions typically represent a small part of the total system cost, but can have a significant positive impact on end customer outcomes. This drives growth, customer loyalty, and strong pricing power. And we are well placed to support our customers in the attractive aftermarket, which now represents around 45% of IMI sales. As we've just discussed, our business is aligned to long-term megatrends and is built on the strength of our One IMI operating model. By applying a consistent approach rooted in commercial excellence, market-led innovation, and continuous improvement, we are creating significant value for shareholders. And underpinning all of this is our performance culture and our people. And we have worked hard to build a culture of ownership, customer focus, and innovation, and are making significant investments in our people to help them grow, develop, and create value for customers. This includes adopting artificial intelligence, and we are rolling out exciting new tools across IMI. And these investments are delivering tangible benefits. Employee engagement remains very, very high, and our productivity has increased by 31% since 2019. So over half of IMI sales are directly supported by rising energy demand and energy efficiency. And I just wanted to share a few examples with you of how this long-term megatrend is supporting sustainable, profitable growth. As you may be aware, IMI is a key supplier to the large gas turbine OEMs, and we are benefiting from very, very strong demand in conventional power. Order intake in the high margin aftermarket was up 16% organically last year, and new construction was up 32%, with the strong momentum driven by widespread electrification and the need for stable, reliable energy to power data centers. Our customers now have significant multi-year order books, and we feel very positive about the opportunities for further growth. We also saw a resurgence in demand for our solutions for the nuclear market during 2025. Plant life extensions present a significant opportunity for IMI, and we saw very strong growth in the aftermarket, where orders were up 33% organically year on year. And we also had a strong year of new construction orders. Thirdly, LNG. While IMI's fluid control solutions play a key role across the LNG value chain, we are particularly excited about the opportunity to support liquefaction capacity additions in North America. We have strong customer relationships, leading technology, and see a clear opportunity to deliver growth. And finally, how the rapid expansion of data centers is not only driving energy demand, but is also presenting an exciting opportunity for Climate Control's energy efficiency products. Our innovative solutions can play a key role in direct liquid cooling systems, and we more than doubled our order intake to £18 million in 2025, with a global opportunity pipeline that continues to expand. We also have an outstanding culture of market-led innovation at IMI, grounded in deep customer insights and executed through our entrepreneurial growth hub model. Our innovations solve complex engineering challenges. Our teams utilize a disciplined test and learn approach to quickly validate solutions and market potential. Through this process, we're able to maximize our return on investment by bringing products to market once customer endorsement has been secured. And our methodology continues to evolve year on year, and we are proud of how we are now using artificial intelligence to help identify and validate growth hub opportunities even faster and with greater precision. Now, the growth hub model is going from strength to strength, and as you can see on screen, we delivered a record £206 million of orders in 2025, up 38% on 2024. And I also just wanted to highlight some of the key roles that process automation looks set to play in the energy transition. So the process automation sector represents around 40% of group revenue, and overall orders have grown at an 8% CAGR since 2020. New construction represents around 40% of process automation, and as you've seen on previous slides, there is renewed momentum across our end markets, principally driven by electrification and data center investments. Adjusting for the disposal of Truflo Marine, over half of our new construction business is directly exposed to gas, power, nuclear, and hydrogen, and we are very encouraged by the outlook for these markets. They support our medium-term growth ambitions and, importantly, expand our installed base, driving the aftermarket and supporting long-term profitable growth. Aftermarket orders represent over 60% of process automation, and as you can see on the slide, these orders have grown to an 11% CAGR since 2020. We actively track over 200,000 severe service valves in our installed base, where our parts, upgrades, and services are absolutely mission critical to plant safety, efficiency, and profitability. By working closely with customers to maximize uptime in their most critical applications, we build long-term relationships and secure recurring high-margin revenue. Now, hopefully you've seen through this presentation that IMI has been fundamentally transformed over the last 6 years as we've built a track record of compounding EPS growth. We have delivered average organic growth of 5% over the last 5 years, supported by our leading positions in attractive long-term growth markets, our success driving commercial excellence, and our momentum driving market-led innovation. Our adjusted operating margin is now at 20%, 580 basis points higher than in 2019, and the continued progress reflects our strong operating leverage, focus on the high margin aftermarket, and the final benefits from our restructuring program. And we aim to deliver further margin progression in the medium term, supported by our strong operating leverage and the growth in our markets. Cash conversion remains very high at 96%, and we are committed to deploying this cash to accelerate growth and enhance shareholder returns. Our fully burdened return on invested capital has now increased to 14%, significantly higher than our 12% underpin and our weighted average cost of capital. So to summarize then, before we turn to Q&A, we are very proud of our opportunities in 2025. Organic revenue grew 5%, the operating margin is now at 20%, and our organic operating profit grew by 8% with strong cash conversion. Our strategy is compounding earnings growth. Second, in line with our disciplined approach to capital allocation and commitment to value creation, we've announced a £500 million share buyback in addition to the 10% increase in the final dividend. Thirdly, we are targeting a 6th consecutive year of mid-single-digit organic revenue growth in 2026 and are guiding to full-year adjusted EPS to be between 136 pence and 142 pence. Okay, well, thank you very much. That concludes the presentation, and I guess I'm going to hand over now to Alex for Q&A.
Yes, thanks, Edward, for taking us through the IMI full year results. Excellent set of numbers again, and the consistency of delivery is very impressive. We are now, as Edward said, going to go over to Q&A. There is a chat box at the bottom of your screen, and if you do want to ask a question, please type it into the chat box and we'll try and cover as many questions as we can. So looking at the first question that was actually sent in ahead of time, it's on earnings. What determines if earnings are at the upper or lower end of the range, and is this M&A dependent?
Yeah, that's a really good question. So obviously we're guiding to EPS between 136 pence and 142 pence. And it's not dependent on M&A. It mainly depends on the end markets. At the midpoint of our guidance, we're not assuming any material recovery in end markets improvements. And I guess if these end markets, particularly the shorter cycle markets like industrial automation and transport, are better than expected, we might be towards the upper end of the guidance. But if things did deteriorate, we'd be towards the bottom end. It doesn't assume any additional M&A over and above the disposal of Truflo Marine.
Okay, thank you. The second question is sort of linked to that, which says the bottom end of the range is only growth of 2.7%, which seems low given what you've delivered, I guess, in the past. Can you explain that or give us a bit more detail around that?
Yeah, no, of course. So I guess I would say we do expect to deliver another year of mid-single-digit organic revenue growth, but there are a few things to highlight as you kind of bridge to earnings per share. So firstly, we are making those additional investments in cybersecurity, which I think is around £6 million incremental OpEx costs in 2026 that will hold margins flat to slightly higher. We also see a bit of a headwind to the tax rate. So our guidance is assuming that it increases from 25.4% in 2025 to 26.3% in 2026. And that mainly relates to the non-repeat of some one-off tax benefits that we benefited from in 2025. And the other important thing really to highlight is that the disposal of Truflo Marine is agreed, and Truflo Marine represents around 2% of group sales in 2025. And our guidance is assuming that disposal completes around halfway through the year. So that does kind of, impact the guidance a bit and perhaps bring the kind of growth rate that you're seeing down a bit. But I think we're still expected to be another year of very, very good progress in 2026.
Thank you. Next question is on the free cash flow. Would you expect the free cash flow and the proceeds from the sale of TrueFlow to cover dividends and the share buyback next year, or are you planning an increase in net debt?
No, that's a really good question. And I think we've been hopefully quite clear over the last few years, spelling out the capital allocation framework. Now, we view an efficient balance sheet as between 1 to 2 times net debt to EBITDA, and would not want to be operating, below 1 times for a long period of time, right? So we ended 2025 at 1 times net debt to EBITDA, and we expect to generate over 300 million pounds of free cash flow in 2026, and we should be generating over 200 million pounds from the sale of TrueFlow Marine when that does complete. So by announcing the 500 million pound share buyback, that will essentially mean that we are able to conclude 2026 at the bottom end of that target range again. So it still leaves plenty of headroom should we be successful unlocking some of these bolt-on acquisitions. But in the absence of those, I think even with the dividend and the buyback, we should still be at the bottom end of the range.
Okay, thank you. Next question here. How important is new product development to revenue growth, and how much of 2025 revenues come from products developed in the last 3 years?
Very, very important. So I think it's probably one of the things that perhaps is maybe a bit understood about IMI, but it's been a core part of the transformation since 2019. We launched the Growth Hub in 2019 when Roy took over as CEO. That is all around working in short sprint cycles to solve our customers' most acute problems and developing new solutions to solve them. So products that have been through the Growth Hub. So I guess this is over the last 6 years rather than the last 3 years, but those products delivered 206 million pounds of orders in 2025, and that's up 38% on 2024. So it is becoming a real engine of growth. And obviously you have products at the other end of the cycle that are coming to the end of their life cycle, but it's becoming quite a material part of the growth algorithm for IMI.
Thank you. I've got 2 similar questions regarding the situation in the Middle East. So can you please give us some flavor on how the war in the Gulf will impact the timing of sales, particularly in the Middle East and Asia Pacific?
Yeah, good question. I probably should start by saying that obviously our thoughts are with those affected by the conflicts. We have about 60 employees in the Middle East, and our first priority was just making sure that everybody was safe and well. The Middle East was around 6% of group sales in 2025, and nearly all of this was in process automation, supplying the large energy projects across the Middle East. Around half of that revenue was in Saudi Arabia, and then the other larger markets for IMI would be the UAE and Qatar. I think it's probably too early to say definitively right now, but we are watching events very, very closely and obviously mindful of the potential direct impacts on some of the projects that might be progressing over the next few months, and then the indirect impacts on supply chains. I guess we still feel confident in delivering another year of mid-single-digit organic revenue growth in 2026. And over the longer term, I think events like this are probably going to put even more focus on energy security that might drive additional investment in this space over the long term. But obviously, we're watching events very, very closely. Probably too early to give a definitive answer. And then, our thoughts are with those that are affected by the conflicts.
Okay, thank you. Next question here. I don't know IMI that well. Please, could you tell me more about your climate control business? How big is it, and what are the end markets?
Yeah, really good question. So climate control is all about energy efficiency in buildings. It's about 20% of the business, and essentially we supply valves and actuators into water-based HVAC systems. So these valves and actuators might be controlling the flow of water in a large commercial building. We own the Heatmiser brand in the UK, which is a smart thermostat, and it is principally a European business because we are selling into water-based systems where North America tends to use air-based heating and cooling. Now, this business is growing consistently at kind of a mid-single-digit level for the last, however long I can remember, right? And that is driven by the persistent high cost of energy in Europe, support and favorable legislation from governments who are looking to incentivize energy efficient spending, and the growth in demand for our smart connected products, which cost more than the analog products, but offer you greater insight, precision, and can help you reduce your bills as well. So it's a really, really favorable environment. And yeah, I think ultimately it's down to the fact that our products in climate control, unfortunately, I don't have any behind me today, but you can kind of pick them in your hand. There would be a single digit percentage cost of the overall system that can have a massive impact on your energy usage. And we've also benefited from products that are being supplied in data centers over the last few years, where our smart connected, it's actually called a TA smart valve, can be supplied into direct to chip liquid cooling systems, essentially regulating the flow of glycol alongside the chip in a data center, ensuring that you are removing the optimum amount of energy. As I'm sure you know, these data centers can get very, very hot, and it's absolutely mission critical that they do not overheat. So that's helped as well. But really, really nice business.
Okay, and then a follow-up to that question. What percentage of the global installed base does IMI's 200,000 valves represent?
So it's about 30%, I'd say. So we've got about a third of the market, and I'd say we're number one or number two. I should just say that 200,000 valves is just in process automation, where they are very large valves that are supplied into typically energy and process infrastructure projects. But in those spaces, we would be, yeah, a market leader.
Great, thank you. And last question, and this three that came in from one of our attendees today. Who are your main European competitors?
Good question. So if I have a think through the sectors, because we tend to compete against different players, I'd say in process automation, Emerson are a very big competitor as they are US based, but yeah, great company, very strong in kind of severe service valves, similar to IMI. In industrial automation, it's a company called Festo in Germany, who are a privately owned business. Yeah, again, very good. In climate control, you have people like Alberts, Danfoss, and also Belimo, particularly on data centers, are strong. In life science and fluid control, I'd say probably Parker, again, a US company, they're a big competitor. And then transport, you're supplying components into heavy duty truck manufacturers. So you typically tend to see that it is dual, triple sourced, for example, but it's only a small part of our business there. But yeah, good competitors. But I'd say IMI has a leading position in our sectors as well. But hopefully that's a bit of a flavour to help you do some due diligence.
Thank you. And look, as a reminder to everyone, if you do want to ask a question, please type it into the chat box at the bottom of your screen. We've got a couple of live questions in at the moment, so I'll take those now. With margins at 20%, is that as good as it can get? And what is the potential on a 3-year view for margins?
No, another good question. And we do see scope for further margin progression over the medium term. Obviously, in 2026, we have the additional cyber investment that is impacting margins. We still expect them to be flat to modestly higher in 2026. And over the medium term, you should see margins progressing. But I guess we're always going to fully reinvest in the business to drive future growth. But after this reinvestment, we think we can deliver incremental margins on future growth of around 30%. So if we can continue to grow the top line at a mid-single digit type level, over 5 years, we should be ending up around 22%. So I do think there is scope for further progression, yes.
Okay, thank you. And the last question we've got in at the moment is, are there any acquisition targets on the horizon? How big could any one acquisition be? And are prices rising or falling?
Yeah, so the acquisition pipelines look really healthy. But we are extremely disciplined. The sort of acquisitions we like are smaller bolt-ons, typically with an enterprise value of between 50 to 300 million pounds, typically privately owned, that we can slot into one of our sectors and really accelerate the core organic growth of the business. These acquisitions might bring unique technology that we can scale across our routes to market, or they might bring an underserved aftermarket where we can apply the same sort of strategy used in process automation to great effects. But we are super disciplined and we're not going to overpay for anything. Any acquisition must deliver returns in line with our WACC, which is around 9% by year 3. and must not be materially diluted to our fully burdened return on invested capital by the end of year 5. And as for kind of price expectations from vendors, I'd say in certain spaces, yes, the prices are kind of prohibitively high, right? If you're trying to buy a business in data centers right now, you'd be paying a multiple where it is pretty much impossible to hit these returns criteria. And some of the markets where maybe the markets are a bit softer, you are typically dealing with privately owned businesses who have a pound million figure in their head that they would like to receive their business. And if earnings are a bit lower, it just means that the multiple that you have to pay is higher. So again, it can become a bit more difficult to meet these criteria. But there are lots of great businesses out there who are out there in the market building the relationships. We're just extremely disciplined and will not overpay. And we know that we've got a great alternative, which is returning that surplus cash to shareholders to make sure we stay within our leverage range.
Okay, thank you. We've had one more question come in. Sorry if I missed it. Do we know what you'll get for the marine divestment?
Yes, I think it'll be. So the enterprise value that was agreed was £225 million. We're obviously waiting for certain clearances because it's a defence business, but the base case is that it kind of completes in the middle of the year. And yeah, it'll be north of £200 million that will receive that business. That's the expectation, which is kind of how we got to the £500 million share buyback when you add on top of the £300 million of free cash flow that we expect to generate.
That's great. Thank you, Edward. I can see no further questions have come in to the webinar today. So that brings us to the end of today's webinar. Thank you very much for everyone for attending. And as you leave, you'll come to a short survey. It'd be very much appreciated if you could complete that. I know management value feedback, so please just spend a couple of minutes completing that form. And if you have any questions, please send them through to info@yellowstoneadvisory.com. So thanks again for attending, and we would hope to see you soon.
Cool. Thanks, everyone.